It's Trading Tip Tuesday, and I wanted to take a minute to talk about open interest, long squeezes, short squeezes, put-call ratio. I'm not going to cover that exactly, but essentially it's all the same sort of thing. These concepts have come into the public's lexicon thanks to the GME and AMC stuff, which I'll also discuss towards the end of the video. But when someone mentions open interest, they're referring to the total accumulative value of long and short positions on any one coin, any one exchange, or in aggregate on all futures markets. You can also refer to open interest on options as well, derivatives, stuff like that. So you can separate open interest into total percentage short, total percentage long. I talk about this in all the articles because typically if one side of the trade is heavily long, you can call that crowded. You can think of it as a high potential for a squeeze. So a long squeeze means if price goes down significantly, those long positions, those positions which expect price to go up, will likely start to close and cause additional pressure on the downside. The opposite is true for a short squeeze. If the short side of open interest is much greater than the long side, that it can be considered a crowded trade and thus be ripe for a short squeeze like GME and AMC a few months ago. So this is one example of one exchange. This is Bitfinex long short open interest, and you can pull this up on TradingView. And by itself, it's not going to tell you too much. You're going to need price. You're going to need some common sense. You're going to need to understand the behavior of the exchange and how open interest has affected price historically. You're going to need to understand whether or not miners are hedging coins on that exchange. If we're talking about CME, you're going to need to understand whether or not these leveraged positions are in a cash and carry trade, meaning they are net neutral, but they are short on leverage. There's been a lot of talk over the past few weeks, especially because of the GME and AMC stuff, that let's go squeeze these leverage shorts on CME, which is possible, but these people aren't net short most likely, meaning they are neutral overall on net. They are 5x leveraged on CME, but they're still holding BTC. So to read stuff like this, I'd say, okay, it's green is greater than red, right? So obviously it's this is just how I have it set up, but massively net long is how I would read this. And you could say, well, there's a concern for a long squeeze here. Shorts are at their lowest level since pre-2018. Unfortunately, I don't have data on TradingView going back that far, but in a perfect world, this would be a strong indication of some sort of long squeeze in the making. Unfortunately, with crypto, each exchange has its own idiosyncrasies regarding volume and open interest. For example, Poloniex, which virtually no one uses anymore, their open interest is going to look a lot different, or their total volumes are going to look a lot different than they did back in the day. Bitfinex, which fewer and fewer people use, their open interests are going to look a lot different than they did in 2019 and 2018 and 2016, where most of the leverage was happening. Bybit, an exchange which is notorious for fake volume and fake open interest, is going to have trouble. You're going to have trouble getting a signal from Bybit that's usable because those values are fake. They're not real, right? So you have to know when you see stuff like, oh, Bybit's open interest is 2 billion, or their open interest went up by X amount, went down by X amount. It's really hard to take any of that seriously. You can say on aggregate, if we look at something like Viewbase, total OI across these exchanges is X, okay? And we can map that out versus price and say when OI gets to a certain level, then price in general is primed for volatility, because if price moves up or down in a violent way, many of these positions are going to get sloshed around. Some are going to take profit. Some are going to get margin called. Some are going to close the position if it goes negative. Their stop losses are going to be hit, that sort of thing. And like it says here, high OI can indicate greed and over leveraging. Low OI falling price may indicate fear and deleveraging. So in general, if price goes down, OI typically goes down. That's generally what we see in crypto because everything's pretty much net long. And how do we know it's net long? We can go to Bitfinex margin long short positions. BTC 93% long. You can go down the list. All of this is green for the most part, over 50%. Even ETH BTC, which looks tragically ready for further lower lows, is 94% long. You also need to consider what percentage of these positions are in leverage. What is their margin call level? What level will they get nervous? What level will these positions start to get underwater? This is all just some little things that are obvious to some people and maybe are under overlooked by other people. If OI is $1 trillion, but the positions won't be underwater until price is 80% below the current price, those positions aren't going to get nervous, realistically. As far as a margin call level, they might start to close as they get out of profit more and more, but you're not going to, it's going to be hard to long squeeze those positions in a sense that they get close to a margin call. That's why it's important to track where these longs and shorts get accumulated versus price. You can look at, here's the block, there's a ton of these websites now. Skew is one, they have a paid service. But you can look at volume open interest on various exchanges. You can look at the total across all the landscape, how that looks between various exchanges. It tends to be more important if you're on a certain exchange. If you're trading on Kraken or if you're trading on Binance and you're looking at that open interest, it's more important to you as the trader there than maybe in aggregate. When BitMEX was a bigger thing, similar to Bitfinex in 2016, when BitMEX was more of a robust exchange in 2019 in an open interest sense, that open interest was very sensitive to market action. If open interest broke 1 billion, typically that was a marker of a top at the time, not so much anymore. So it's stuff like that. This is changing and evolving over time. Different exchanges take prominence over time. As far as the IT exchange, or where most of the volume happens, where the important volume happens in a sense that it moves the market. OKEX historically has been an important avenue as well. You can expand. This is just view-based, which some people were saying isn't a good website a few days ago. Whatever, use whatever you want. I don't care. But use stuff like this to see where all this open interest is sitting. Again, Bybit at 1.7. A bit laughable considering, there's plenty of evidence that Bybit gooses their volume. Binance does the same. OKEX does the same. The list goes on and on and on. So it's hard to take much of this seriously. Huobi, notorious for doing the same. Most of these Chinese exchanges do not have legitimate volumes and therefore do not have legitimate open interests. But you need to take all of this into consideration. If I'm opening a long position and longs are 99% and we're at a local top and we're getting a bearish divergence or we're getting a rising wedge and we're hitting a yearly pivot and we're 15x from the 200-day moving average, I'd say, okay, the stars are aligning here. Open interest is 12 trillion and the crowded trade is clearly the long side. Maybe it's a bad idea to open a position up here, because if this starts to go down, if the music stops, right, there aren't going to be enough chairs or exits for everybody to get out. And that's typically what you see in just crypto in general. Everybody's over leveraged. Everybody's super excited about the long side, not so much about the short side, which is understandable. But you have to keep that in mind. So always pay attention to stuff like this on the various exchanges that you're trading on. And we saw one such example of that in 2016 on Bitfinex specifically. I don't have data on TradingView dating back that far, but this is another good example because we were consolidating for 250 days or something like that, and short interest was at an all-time high. It was a crowded trade, and if memory serves correctly, we partially moved off of this short squeeze on Bitfinex. So the open interest will help fuel the opposite side of that position, because those shorts were closing up here. They had stop losses here. They eventually got margin called. They were underwater, and that forced price higher because they had to buy back their BTC. If we look at Bitfinex BTC OI historically versus price, you can sort of construct a narrative where you'll see peaks in open interest at highs or lows typically. So if shorts are an all-time high and its price is down 60 to 80%, you have to question to yourself, do I want to be on that side of the trade? Which historically eventually goes the opposite way. Most people in aggregate are poor traders, and you can see that on open interest because you'll see open interest go super high after the move, and then those people are considered late longers or late shorters, and then price will invariably go against them. It's like clockwork. Like I mentioned earlier, it's hard to look at any one exchange over time because the sands of open interest are shifting quickly. I think at the time we considered much of this being a minor hedge potentially in 2019. And you can also look at open interest to see whether or not a move is completed. Oftentimes the market will seek out high open interest like a missile. If longs or shorts are an extremely high percentage, most of the market is aware of that. And the market tries to go in the opposite direction to encourage those positions to close and making the squeeze more profitable. We used to see that on OKEX futures all the time. You'd see a specific trader or a specific set of traders sitting on one side of the trade super heavy, and the market goes in the opposite direction just to margin call those specific people. And that's probably a product of manipulation more than anything, but you got to pay attention to that sort of stuff. So seeing, long short ratio right now in BTC at 93% is a bit problematic for the long side. I'd feel much more comfortable on the long side if shorts were a greater percentage, or if this was 50-50, something like that. You can see how the shorts came off during the highs, as did the longs. Longs reaccumulated at the lows, thus continuing the cycle of life. But you can see what happens here on a long and short side, who's taking profit, where and when. I have ETH. So ETH USD was another one on Bitfinex specifically, where this is the notional value. So this is the USD value. And I divided this by 1 million. So this is I think it's 1 million, right? 100,000, whatever it is. I think it reached 2.3 billion is what it ended up being. But eventually, one of two things happens. Either the notional value gets so high based on price appreciation that those positions begin to close because they're in such insane profits, or it gets so high that the market goes against them to cull that position and feed the profits of the people trying to predatorily, in a predator sort of way, get rid of that position. So we saw the notional value rise with price, and then it dropped dramatically at these highs, which was another potential suggestion that the move was over. The investment in that buy-up, that run-up, quickly got dissolved, and whether or not this happened on the exchange is questionable. It's Bitfinex after all. But again, these are the sort of things you got to pay attention to. What is the market confidence based on open interest? Is everybody super long? Is it neutral? Is it super short at the bottom? Are there late longers? Are there late shorters? How can we screw over as many people as possible? It's basically what the market's always looking to do. Real quick about GME and AMC, just as we saw the short squeeze leading into that 2016 ascending triangle run up after consolidation, we saw it on GME, and it takes a certain situation. You can't have the squeeze setup that you had on GME as prices falling. It's natural for people to add shorts as prices falling. Where the greed and fear comes in is where people continue adding on to shorts after 6 months, 12 months of consolidation. In legacy markets, it can last a lot longer, more so than crypto markets. But you had DFV, the guy saying he bought $50,000 worth of calls on GME, whatever. I forget when the exact time was, but what he was looking at was the long short open interest, and he saw that there were more shorts than actual shares in existence. So he noticed that this was ripe for a short squeeze. So you have those situations. We had the fundamentals of Corona and GameStop and retail in general, but you also have the technicals and the market dynamics of open interest with shorts being greater than total existing shares, aka ripe for a short squeeze. We had a year-long plus consolidation, which mimicked an inverted head and shoulders roughly. You had a break of the 200-day moving average. So all of these things together led to this October through February move, which on any other market happens all of the time. You had people who were greedy down here, hedge funds, just, sharks smelling blood in the water, who wanted this to go to zero, who wanted GameStop to go bankrupt. And at the end of the day, what happened was a massive short squeeze. So we can blame, you see certain media outlets blaming, Robinhood or Reddit for stuff like this. But the reality is it happens all the time in every market, and it's natural. It was a giant short squeeze. Is it divorced from fundamentals of retail entirely? Yeah, but it's also a giant short squeeze, which was divorced from reality in the first place, in that shorts were greater than existing shares. AMC, same things. No one's going to the movie theaters right now. Most movie theaters are closed around the country. That also had the conditions that were ripe for a short squeeze, in that I believe there were more shorts than existing shares. So the bottom line here is, if you're trading on margin, if you're trading on leverage, if you're trading on a crypto exchange where you can view long, short, open interest, those are all exchanges as far as I'm aware. It's important to pay attention to who's on what side of the trade, for what duration, for what percentage, what is the market's total sentiment. That's basically what you're viewing here is market sentiment. Does the market think AMC is going to zero? Does it think GME is going to zero? Did it think BTC was going to zero in 2016? This is the same story over and over again. Now you could say, does the market think BTC is going to infinity, right? Based on this long short OI. So it's reasonable to get nervous up here if you're on the long side of that trade. So hopefully this helped your understanding of open interest. If you have any questions about squeezes, long, short stuff, options is a completely different animal. Put call ratio is another thing. Essentially the same type of long, short squeeze. If you have any questions, let me know in the comments below, and happy trading.